Hi guys, welcome to Stacking Stocks, and many thanks for tuning in today. As usual, we are super elated to guide you on your investment journey. Today, we'll discuss two underrated stocks you can buy before 2022. With the stock market persistently moving higher, two companies are solid bargains as 2022 comes into view. Many popular technology stocks are beginning to look expensive, so investors need to work harder to find affordable growth. These two stocks could deliver returns that will make your portfolio shine in 2022 and beyond. You're probably wondering which stocks we're talking about. We will discuss the pros and cons of Cohu and GoPro. Have you heard about these two stocks? If you haven't, don't worry. We'll give you all the information you need to know about these two stocks. The S&P 500 stock market index has delivered strong returns of approximately 20% year to date, and it has done so with a remarkable lack of volatility. There hasn't been a single 10% correction so far this year, so investors haven't been presented with any significant dips as buying opportunities. With just a few months remaining until we ring in the new year, it's time to start thinking about an investing strategy for 2022. Since the market is hovering near all-time highs, investors can benefit from being more selective as many of the popular high-flying growth stocks already look expensive. Have you identified any profitable companies yet? Are you prepared for the new year? Or maybe you're comfortable with your investment portfolio as it is. We've established that investors ought to be up to date with the stock market. If you're an investor, you need to be aware of such underrated stocks with so much potential, especially now that everyone is still recuperating from the negative impact of the pandemic on the economy. Most investors are probably keeping track of how giant stocks are performing. Yes, everyone wants to find out if such stocks will recover. But scouting underrated stocks is also a smart move, and as always, we're here to guide you. Nonetheless, have a look at these two companies that are being overlooked by the market and could be perfect picks to supercharge returns starting next year. Let's begin with Cohu. Are you finding out about this company just now? What does it specialize in? Cohu is a semiconductor service company that provides essential testing and handling equipment to the world's largest semiconductor producers, and it has pivoted its focus to its automotive-related product line to help alleviate the industry's supply issues. The company recently revealed this strategy continues to attract new customers. Semiconductor shortages have been a dominant concern for key industries like automotive manufacturing throughout 2021, as they've caused major production delays. Consumers who have tried to purchase a new car this year might have noticed the lack of inventory at their local dealerships and the soaring prices in the used car market. New cars keep getting smarter, and they require more processing power as a result to facilitate their digital features. As you can see, Cohu seeks to address the issue of semiconductor shortages for key industries like automotive manufacturing in 2021. It seems like the industry was hit hard, which affected the production process, thus leading to massive delays. But with Cohu formulating a strategy whereby the company majorly focuses on its automotive-related product line, the industry is set to improve in the near future. We're talking about a massive turnaround by 2022. The automotive manufacturing industry is one of the giant global industries. The revenue flowing from such an industry is massive. As a matter of fact, we have witnessed consistent growth in revenue for the last 5 years. We have estimated growth of up to $902.7 million in 2021, from $282.1 million in 2016. This represents a compound annual growth rate, CAGR, of 26%. If this doesn't convince you to consider adding Cohu to your investment portfolio, no problem, because we've got even better statistics of this underrated company. So far, don't you think the numbers are beyond impressive? While Cohu has increased its revenue at a quick pace over the last 5 years, growth is accelerating sharply this year, which highlights the booming demand for its products and services. Our analysis of the company's earnings report shows that there has been a sharp increase in revenue in the first half of 2021, with returns of $470.3 million compared to $283 million in the first half of 2020. This represents a 66% year-over-year change. Cohu has been posting great results over a long period of time, and we think things are set to get even better in 2022. We think that the semiconductor shortage will continue into 2022, so Cohu will be able to continue adding to its customer list as producers try to increase manufacturing capacity to meet demand. We also expect $3.05 in earnings per share for the company this year. The stock trades at a multiple of just 11.2 times. Compared to the iShares semiconductor ETFs, earning multiple of 37.3, Cohu looks like an excellent value. its share price would need to triple with no change to its bottom line in order to align with the valuations of its industry peers. But the company is also expected to generate over $3 in earnings per share in 2022. Its prospectus are bullish enough such that we believe the stock could rise to $65, which is more than a 90% gain from its current price. As we mentioned before, you don't want to miss this huge opportunity. With the company striving to cover the semiconductor shortage, there is a guarantee of increase in sales and returns. This means that stock investors also stand to benefit massively from the semiconductor shortage. Can you imagine missing out on a massive reap of profits? Well, we suppose not. Cohu stock is a top prospect that deserves a chance on your investment portfolio. Another profitable company that would be a perfect addition to your investment portfolio is GoPro. Is it a familiar term? Many investors have forgotten about GoPro, and it's no surprise given the stock has fallen over 85% since 2014, its debut year as a public company. Despite being the leader in the action camera industry, investors perceived GoPro as too one-dimensional with limited growth prospects. But that's changed recently, with several new initiatives announced since 2020 to turn the company around. Rather than selling all of its cameras at a wholesale rate through retail channels, it built a direct-to-consumer business on its website. GoPro.com accounted for over 50% of sales in the trailing 12 months. And in the second quarter, gross margin expanded 950 basis points year over year to 39.8%, making the company more profitable. Isn't this what any investor would consider remarkable? The incredible thing about GoPro is the fact that it's been able to recover from a massive decline. Unlike many other companies that would have chosen to halt operations and close down, GoPro came up with new initiatives to turn the company around. And ever since it started implementing the new strategies, the company's been picking up. Another big contributor to profitability is GoPro's new subscription business, which delivers a gross margin in the range of 70 to 80%. In Q2 2021, GoPro subscribers rose to a massive 1,160,000, up from the 372,000 in Q2 2020. This represents a 212% year-over-year change. This is beyond impressive, and we expect the company to do even better come 2022. But what are the numbers in terms of returns? Are the figures appealing enough? Let's find out. Customers loyal to the GoPro brand can subscribe for $49.99 per year to unlock a range of exclusive benefits, including product discounts, unlimited cloud storage for videos, and replacement cameras in the event of damage. The initiative has been incredibly successful and could generate $90 million in recurring revenue in 2022, most of which will be gross profit. GoPro is heading into the quieter fall and winter months in the US and European markets, but regardless, Asia Pacific has recently become the fastest growing region for the company. This will be important to watch as we enter 2022, since that region will be in the more active summer season. The company posted $41.8 million in revenue within the Asia Pacific region in Q2 2021, increasing from the $16.7 million in Q2 2020. This represents a 150% year-over-year change. You might want to add this to your investment portfolio. The two companies display so much potential. Watch out for them. Anyway, thanks for tuning in today. Remember to like, share, and subscribe. Until next time.